Okay, so this session is something of a part of a series, in fact, and it's something I talk about quite a bit. This phrase that you've probably heard other places, but heard me say once or twice. This idea of the laws of the universe, and again, I just can't stress it enough. It's just all about getting away from emotion-driven aspects of trading and investing. So there is going to be some numbers involved. I know a lot of people tend to go to sleep when they start hearing about mathematical concepts, but they are absolutely crucial. Please do understand that. If you are venturing into this world of financial markets, underpinned by all these economic principles, then yes, you are going to have to get a little bit of maths involved. That's the bad news, if you want to call it that. The good news is that you don't have to be a rocket scientist, and it's really not that hard if you actually invest the time to get it ingrained within your grey matter. And at the end of the day, it's there to make you a lot more content and less anxious and more mentally focused and clear thinking, all for the sake of just having to invest a little bit of time to understand some of these concepts. And I know, God forbid, you have to pull out the calculator every now and then to go through some of these things before you actually make an investment, but we'll do our best to make it as simple as possible. Now, I'm not a mathematician by any stretch of the imagination. But I had to learn these things in order to not just understand what was going to determine what was going to make me successful on a personal level, personal trading / investing level, and obviously, of course, I had to understand these things when it comes down to analysing and reviewing strategies, and of course doing risk allocation and portfolio allocation on behalf of my clients. But the mathematical concepts that I apply to on behalf of my clients, and the analysis that I employ on behalf of my clients, is essentially the exact same form of analysis that you can apply for yourselves as well. So what we want to do is we want to get past this idea of gambling, get past this idea of hope, and we want to get to the point where we actually truly are investing / trading based on something called expectation, or reasonable expectation, rational expectation, as opposed, once again, to hope. So this idea of investing and trading is, for the sake of this session and for the sake of the way you really should think about it, should be used interchangeably. So when you invest in a particular model or system. Even if you're investing in a company like BHP or CBA or Telstra or AMP or whatever it may be, you're investing in a business model. When you are a quote-unquote trader, you're running a model yourself, and therefore you're essentially investing in yourself, as opposed to investing in someone else's model. You're just investing and running your own model or system. So we need to the exact same concepts apply. We just need that they're just employed in different ways, depending on whether you're a quote-unquote investor or quote-unquote trader. And realistically, there's just a lot of overlap, and it gets really into the semantics of things. So just be clear about that. Investing and trading, certainly for the sake of these foundational type principles that we're discussing in this session, are exactly the same. All right. So Jim Simons is someone that we take a lot of inspiration from when it comes to these types of systems, and not simply because he's the most considered the most successful hedge fund manager of all time, running for several decades now, but because he is not a Wall Street guy, he's not a finance guy, he's a mathematician. He was a professor of mathematics for several years at a major American college, UC Berkeley, in fact, and then he ended up going into the finance space. So a couple of his quotes that we like to remind people of when it comes to these things, because people tend to think that the markets are random. Now we want to delve into the definition of this word today, random, because it's very important to understand. His quote there is that there are patterns in the market, and I know we can find them. And of course, he did, by all reasonable measures. And we want to talk about using past performance data, information available, that is, in a very broad sense, as the best possible indication or predictor of future success. So again, we've all heard this thing that past performance is not, a reliable indication of future performance. Well, essentially nothing is any kind of guarantee of what the future is. But if we do look at the way something has behaved in the past, that is actually the best idea or information that we can use to extrapolate into the future to try to basically determine how well something is going to continue into the future. But we'll talk more about that as we go through. Okay, I really want to make this clear to everyone. It's a big challenge that I have, because this industry, this financial markets, this financial services industry, and I'm not just talking about the small little gimmicky operators that you find around the internet. You can follow this philosophy all the way up to the top end of town. It's all very sales and marketing driven, and no one actually really wants to take the time to try to teach you what's actually really determining and underpinning the success of any particular investment or system or model or strategy or methodology or company or whatever it may be. And it's because everybody is playing into the short-term emotion-driven side of your mind, which just wants the glitz and glamour, and to imprint upon you these ideas of jet skis and cruises and trading on the beach and retiring early and all these emotional-driven things, which are of course what we're in it for at the end of the day, but isn't what is actually going to drive your underlying success. So the industry is all about selling tickets, and they do this through talking about returns, but they don't focus upon what's actually going to give you a much higher probability of actually achieving those returns and all the things that you're in this business for at the end of the day, because that doesn't sell tickets. So offense sells tickets and defense wins championships. We want to be more about the steak rather than the sizzle, to put it another way. And the defensiveness first approach is of course crucial, because we do have to incorporate the idea into any system that there are unpredictable events. There are not just unpredictable events, but there are unknown unpredictables, and that's what they call these black swan events. And the most recent one we've had, of course, is a very, very good example of that. So when you jump onto Google and start bouncing around the industry and attending different webinars and getting different PDFs and all these other things, you're going to get bombarded with all this information about technical analysis, fundamental analysis, Heikin-Ashi, Fibonacci, expert advisors, martingale, all these other types of fancy ways of, again, supposedly generating profit. Not just the small and gimmicky type stuff, but all the way up to the top end of town. They all love to focus upon how good they are at predicting the future, when if you actually talk to someone who number one truly knows what they're talking about, and number two is actually going to be honest with you, they will admit to you that there's only so much that you can do to predict the future, and that the majority of these types of technical analysis and fundamental analysis and other prediction type tools only have limited effectiveness, and limited effectiveness, very importantly, in specific circumstances. So they shouldn't be overused, and they should only really be used for what they're intended to do. You should only ever really use the tool for the job it was designed for, and just generally not be so over reliant upon them at all. So predicting the future, improving your accuracy, which we're going to talk about today, in this session, improving your accuracy is the tip of the spear. It's something that you can refine and improve over time, but it's not going to determine your long-term sustainable, and the key word there is sustainable, success. So tip of the iceberg, top of the pyramid, whatever you want to call it, what any particular system or approach or methodology has to be based upon, and I want to say that intentionally strongly, has to be based upon certain risk and money management concepts, which again are just centered around essentially relatively simple mathematical concepts. Risk reward probability assessment, which we have another session on, risk relative position sizing, and something called EVA, which we touched upon in the last session. We're going to be talking more about today. EVA, expected value or expected value average. Now this is what's going to, again, determine your long-term success, give you greater peace of mind, and actually make your approach sustainable, something that could work into the future. So I need to make this very clear, because people think, and it's happened to me multiple times when I've tried to teach this to people, is they think that I'm trying to teach them some kind of method of analysis, some other type of strategy or methodology, or some other way of approaching the markets. This is nothing. This, in actual fact, is nothing to do with the markets per se. This is a laws of the universe type concept. It's absolutely going to underpin any type of approach you have, whether you're a long-term investor, dividend investor, fundamental analysis, technical analysis, systems developer. It absolutely doesn't matter. You have to understand these things if you're going to be the sort of person, or the sort of trader / investor, that is actually relying upon objective principles and rational principles, as opposed to hope and wishful thinking and as all the other sort of self-delusion and self-deception type things that we are all prone to. We're all prone to them. So a good way to get rid of those, or at least stamp out and dampen those human tendencies, those all too human tendencies that we all have, is to, again, have this logic and rationale-driven objective foundation that you can base any style or approach or your market instincts on over time as they develop. So that's a crucial concept to understand. Technical analysis and fundamental analysis is only going to get you so far, and it's only going to be useful in certain situations. Everything has to be founded upon risk reward and risk relative position sizing, expected value averages, and a couple of other concepts. But the most important concept of all, of course, as I say, is the mentality, and there are entire fields and books and very well-renowned experts purely devoted to this idea, to the pursuit of trading psychology or investment psychology, market psychology. So it all really does come down at the end of the day to your mentality, and you do have to approach this, again, if you're going to give yourself any reasonable chance of success, sustainable success. You have to approach this with an objective and critical thinking and a business-minded mentality, essentially. Okay. So, if you ask an experienced trader, they essentially agree with me here. If they're experienced enough and they've been around enough, made enough mistakes and all the rest, they'll tell you that everything really comes down to risk management and psychology. And the idea that I want to impart in this session, as well as so many others, is that risk management and psychology are actually two sides of the same coin. The better you have your risk management down, the better you have a logical understanding of risk reward and probability and uncertainty and profitability, and think in terms of systems instead of trades, then the easier it is to manage your mentality, the easier it is to stay focused and approach the markets with the right mentality. So let's talk about that, because again, whether you're looking at an individual specific trade or whether you're looking at investing in a company, whether you're looking at investing in a managed service or a purely algorithmic trading system, it doesn't matter. We have to ask ourselves, does the opportunity make mathematical sense or does it not? It really comes down to that at the end of the day, because if you're not doing that, then you're operating on something else, some other basis of hope or wishful thinking. We don't want to do that. So the common question that comes up, and I'm absolutely amazed at how much life this has had throughout the industry, around the industry, I should say. Yeah. The question is, is trading just gambling? Well, some of the more experienced traders will tell you, no, it isn't. But not many of them actually are able to explain to you why. And we want to be really clear about this, because I actually even hear some well-renowned people, some quite well-known people, either not explaining it properly or even suggesting that it effectively is gambling. Now, I want to make the difference clear here, because it does really come down to some very key definitions. So the actual correct answer is that it can be if you want it to be. So you can gamble on anything. You can gamble on politics. You can gamble on absolutely everything. And so when you approach these at the markets, you've really got to ask yourself, what sort of approach you want to take, because again, so a lot of people think that these two people are the same. They think that this guy and this guy are essentially the same guy. Well, there are some overlaps and there are some similarities, but we do want to be very clear about the differences and the distinctions, so that you can decide which one you want to be. So obviously they're both sitting there staring at screens and getting emotional about things. Obviously there's elements of chance and uncertainty involved, and when you ask the person on the street, the majority of people are going to tell you that trading is gambling because there is something called risk involved. But obviously that is a very, very overly simplistic answer, an overly simplistic explanation, because everything involves risk. Unless there is certainty, there's always risk, and nothing is certain. You can invest in real estate, which is, depending upon the type of real estate investment you're doing, is either going to be safer or less safe than approaching the financial markets. But no one calls a real estate investor a gambler, of course. In fact, absolutely every business is based upon these same principles and has an element of uncertainty. There, you can go and start up a bakery, start your own business, any business at all. There's going to be elements of risk involved, but nobody calls the baker a gambler. In fact, if you were the owner of the casino, if you go and start up your own casino, your entire livelihood, in your entire day-to-day operation is completely centered around games of chance, statistical probability, and winning and losing large sums of money in a essentially unpredictable fashion on a short-term basis. Yet nobody calls the owner of the casino a gambler. Okay, they call his clients gamblers, of course, but not the owner of the casino. So there's always this element of chance involved in everything, all aspects of life, and there's always an element of uncertainty. And in fact, if we take a broader perspective and look at the world at large, we can essentially determine that entire economies and entire global systems are built on this idea of uncertainty and risk-taking. So it's certainly not a matter of risk or uncertainty in determining whether you're a trader or a gambler. It does actually come down to understanding probability, understanding randomness and what that actually means, and getting yourself to the point where you're not the guy that necessarily needs 12 different screens and jumps up and down every time there's a winner and thinks about jumping out the window, every time there's a loser. You want to get yourself to the point where you can just have at least some essential understanding of these mathematical concepts, so that you can just approach things from a purely objective and critically thinking standpoint. Again, referring back to Mr. James Simons there. So that's what we want to do. Okay, so what is random? Well, it's an idea worth understanding, because what we do as human beings is we tend to confuse short-term concepts with long-term concepts for emotional reasons, and all too human reasons, as always. So what is random by definition? So the dictionary definition there is proceeding, made or occurring without definite aim, reason, or pattern. The key word there is reason or pattern, and we actually don't know what's random and what isn't. That's what a mathematician or a statistician will tell you. There's no definite way of determining. What we want to do is we want to get ourselves to the point where we have a practical definition of certainty or uncertainty, practical certainty or practical randomness. But the key point there really is that if you're proceeding without a plan, or without a structure, or without understanding of some of these concepts, then everything is effectively random. And we don't want to do that. So, in actual fact, there is no such thing as random. Random is the word that we use when we don't know the cause. But in actual fact, everything is a cause and effect question, concept, phenomena, you might say. And global weather systems, or weather systems at large, are a good example of that. For a long time throughout history, we considered weather to be random, especially if you've never left your little island or your little desert. But as we send satellites into space and we put different temperature sensors around the world and do all these other things that we're doing now as human beings, we collect very large amounts of data, and we can look for patterns, and we can see that while weather is not completely predictable, it does actually occur according to a somewhat reasonable, somewhat predictable pattern in depending on where you are in the world and what time of the year it is, and all the other things. Even if it's a quote unquote imperfect science, through again taking large amounts of data and analysing patterns and looking at statistical probability, we can actually we can reach a point where the predictions that we can make from data are actually useful. They actually help our lives. So weather is a good example, and nothing is actually random just because we can't predict it. No effect, again, is truly random. Everything has a cause, even if you don't actually know what the cause is, because we can't know all causes. We don't have all the data, and we don't have the formulas to interpret all the data. So again, random is essentially just a word that we use when we don't know what the cause is, when we can't explain the reasons. That's what random actually means. But again, repeated effects of a probabilistic, not certain, but probabilistic predictions that we can use to our benefit. And ultimately, the more clarity of probability that we have, along with defined risk and reward, and risk versus reward, arms us with the ability to make better decision making. And that's what it all comes down to at the end of the day, is better decision making. So if you think back to the earlier piece talking about how everybody loves to talk about different tools and indicators and other methods of trying to predicting the future, yes, there is yes that can and will help you improve to a certain degree, tweak to a certain degree, but the true experts of this industry know that this is really all about assessing probability. The better you can assess probability, the better you can make a decision accordingly, according to your risk parameters and all the other things going in your life and so on. Okay. So a casino operator, and in fact any business, should operate on this idea of this concept known as game theory. And game theory is summed up or defined as decision making under conditions of uncertainty over time. So there is no such thing as certainty. There is only probability. If we have a high probability of something and we're willing to accept the risk, then we can make a decision. Again, if we can predict the weather, we can't predict the weather with certainty, but if we can predict the weather well enough to decide whether it's worth the risk of going to the beach on that particular day, then we have something we can actually use in our lives and in our investment plan and in our trading plan and so forth, something that we can use to actually benefit us. But that's what game theory is. There is no certainty, there is only probability. And it comes down to the decisions that you make under conditions of uncertainty. Gambling, by definition, is to play games of chance for money. And two, the more important one there, take risky action in the hope, underscored there, hope of a desired result. Whereas investing, and again, it doesn't matter whether you're a trader, investor, systematic investor, fundamental investor, long-term value investor, dividend investor, it doesn't matter. Or if you're a trader, once again, you're simply really just investing in yourself, investing in your own system, your own model, your own approach, as opposed to someone else's. But investing by definition there is to put money into financial schemes, shares, property, or a commercial venture with the expectation of achieving a profit. And that's what it really all comes down to, ladies and gentlemen. Please understand this. It comes down to hope versus expectation. You want to get yourself to the point where you have a rational expectation of achieving a profit rather than just a hope. So you don't have to have a high degree of certainty, and you don't have to have a high degree of accuracy. This is a common way in which people are confused by the numbers there. The numbers just have to play out over time if you were to repeat them consistently and repeat them with discipline and repeat them with proper risk management. So that's Jeff Bezos there, as many of you will know, and one of his quotes there is that given a 10% chance of a 100 times payoff, you should take that bet every single time. So I wanted to emphasize this for a couple of reasons. Number one, you don't have to have a high accuracy system. You don't have to be able to predict the future with a high degree of accuracy. And number two, obviously Jeff Bezos isn't a Wall Street guy. He's not a finance guy. This is a foundational mathematical truth that applies irrespective of whether you're investing or in business or whatever the case may be. So let's try to maybe put some of this theory into practice. So this is the expectancy calculator that's on the website there. If you need a link to that, let me know. And what I've done here is I've prepared three versions of this. One is with low accuracy and high reward, as Mr. Bezos has just mentioned. This is low reward, high accuracy, and this is sort of mid-range. So let's go test Mr. Bezos' theory there. Let's say we have 100,000 in the account. Let's say we're risking 1% of the account to keep it relatively conservatively. Now the risk reward that Jeff is talking about there is actually a 100 to 1 risk reward, 100 times payoff, as he says. Accuracy is just 10%. Okay. So the three the key inputs in this, the key factors, are your account balance, your acceptable risk per trade, your acceptable risk to reward ratio, and your accuracy, your win to loss ratio, in other words. Once you have that, you have something called expectancy, and then your return is going to be determined by how often you can apply a methodology like this, or a criteria like this, to the market. In other words, how many opportunities, trades, investments, how many opportunities you can find and capture that meet this criteria. And so that's what you have there. So we'll say, let's say you did one a week with 2 weeks off per year. 100,000 in your account, risking 1% per trade. According to Jeff Bezos, 100 to 1 risk to reward ratio with a 10% accuracy rate, and you can find one a week. Well, your percentage return there is going to be 455%. Okay. I want to make that, just wanted to use that to illustrate the concept that you don't have to have a high accuracy system. You don't have to. It's all comes down to the way the trade-off between the key factors there. But high level of accuracy is not necessarily the one that you want to be looking for. The downfall of a high accuracy system, the downfall of a system like this, is of course that it's very rare to find opportunities that pay off at 100 times their risk. Okay, so you might have something closer to, well, you know, let's just take a look at, so you had 5 of those per annum. Even at 5 per annum, it's a 46% net return. So, but just to be very clear, those types of opportunities are very, very hard to find. In fact, you might even get one of them a few years, perhaps. Who knows? But I just wanted to give you the example there. So let's take another high reward, low accuracy example there, and we'll say we've got 100,000 in the account. Once again, we're risking 1% per trade. We'll say a risk to reward ratio of 3. In fact, we'll make it 5, and we'll say we have an accuracy rate there of 1/3, 33%. So you get it right 1/3 of the time. So these types of opportunities obviously would be a little bit easier to find than 100 to 1 ratio. So let's say you had 26 of those per year, or let's say 12. Let's say you found 1 per month. So that gives you a 12% per annum return, as you can see there. Okay, you're only getting it right, quote unquote, right, 33% of the time. Okay, this is very, very important to understand, because a lot of people do get very caught up on the idea of getting it right all the time, the idea of a high accuracy system, and if they might see 2, 3, 4, 5 different trades or investments that lose them money in a row, and they start to think it's the end of the world. Well, it's not the end of the world. It's just the way that the odds are playing out. So you need to have enough data behind you in order to understand, or in order to make a more reasonable or rational determination as to whether your system does have a profitable expectancy, or whether it's sort of just random. And it's not that easy, but I want to give you another example here just to illustrate the concept, because again, people really just don't even really understand what this word random is, and they still have an idea. Not all clients, but some clients, and too many clients, to be honest, too many people. And so this is essentially for them. Too many of them are still governed in a sense by this idea of luck. Well, again, if you're going to get serious about this game, then you've got to delve a little bit deeper into the actual meaning of these words, so that they don't have too much of an effect upon you psychologically. Again, so that you can make better decisions when you're in the heat of the moment and markets are moving, and you've got to make a decision. So what is luck? Luck is not really a cause. Again, thinking back to the weather systems, luck is not a cause. Luck is a description that we apply to the effect. Okay, so it's an adjective, it's not a noun. It's an adjective that we apply to a description that we apply to the outcome of something, according to how it affects us as an individual. So it's just a purely subjective, and it's effectively a made-up concept. There's really no such thing as luck. There's cause and effect, and there's statistical probability. So this is a dice roll simulator here, and we're rolling 3 dice in this instance. And what this axis does here is it measures tracks the totals of the 3 dice rolled. So roll it once, and we've just got 8. We've scored an 8. Now we've scored an 11 and a 13. There's a 12. Keep going. And so now we have 6 8s, 4 10s, 2 7s, and so on. So if you were to subscribe to this idea of luck, or if you were just thinking too short term and thinking too much upon small data samples, and to relate this back to the markets, you might think that whatever methodology or strategy that you applied to get this result is a winner. You might think that this is a really good way to predict the future. So if you'd used Fibonacci here, but you'd used let's say moving average system there, then you might be inclined to think, or you would be inclined to think, in fact, that Fibonacci is somehow magically better than a moving average. Okay, but what happens, of course, if you start to repeat things? This is really the concept. So if you had no approach whatsoever, you would be thinking that these are just random occurrences, but they're not. So instead of rolling 1 at a time, let's start rolling 10 at a time. Okay, so now things are looking a little bit different, and now it doesn't really look very random. It looks like things are happening for a reason, and that there's a pattern, there's a statistical pattern in play here. So let's start rolling 100 at a time. So we're up to 300 rolls. Sorry, 600 rolls now, by the way. And now things are starting to look different again. And so now let's do 10,000, just to try to make this really clear. Okay, so now we're up to some 50,000 odd rolls. And now what you can see is that this looks anything but random. It looks like there are very clear reasons for the outcomes or the effects that we're noticing. We may not even really know the cause or understand the cause, but we can say with a very high degree of confidence that this is really nothing to do with luck or randomness. Okay, so thinking a little bit more deeply into the cause, it's with a die that has 6 outcomes each, 3 of them. It's naturally, of course, much easier for there's more possibilities and therefore more probability that it's going to produce a total of 10, as opposed to, example, a total of 3 or a total of 18 because there's only one combination, 3 ones or 3 sixes that would produce you these kind of outcomes, where there's many more combinations that would produce you these kinds of outcomes. So again, this is nothing to do with opinion or strategy. This is just laws of the universe type stuff that we have to understand if we're going to approach the markets with, any kind of rational and reasonable expectation of profit, rather than the hope of profit, and resign to these primitive concepts like luck and other things. So that's that, and so that's it. This one here is an example of, again, just to recap, low accuracy, high reward relative to risk. So let's take another example. So we'll say the same 100,000 in the account. We'll say the same sorry, just a second. All right, so let's say the same 100,000 in your account, the same 1% risk. So on this one we had a 5% risk to reward ratio with a 33% accuracy rate and 12 trades per annum, or investments per annum, doesn't matter, 1 per month. With this one, we'll say we've got same 1% risk, and this one we'll say we've got a 1.5 to 1 risk reward ratio, and we'll say that we get it right 60% of the time. Well, let's say 66% of the time to make it 2/3. And we'll say we've got the same 1 trade a month there. 12 trades per annum. Well, in this instance, we end up with a lower return there of 8%. But the thing is, with this kind of system, it's producing opportunities which are easier to find, because a 1.5 to 1 risk to reward ratio type opportunity, one that's based on proper objective reasoning, mind you, is much easier to find than one that's based on a 5 to 1 risk to reward ratio. So, and that's a key thing to understand. So that instead of producing 1 per month, let's say it did 2 per month, 24 per annum. So now we end up with a 16% return on our 24 opportunities per annum. Okay, so this one does 12 opportunities per year and returns 12%. This one does 2 per month instead of 1 per month and returns 16. So a little bit better. Well, what if you could do, let's say, 1 per week? Okay, we'll make it 50 to make it easier. So we'll say 1 per week, plus you take 2 weeks off per year. So now we have 33% return as opposed to a 12% return. Okay. So the key point with this one is that you're only trading once a week. You're only trading / investing, doesn't matter. Once again, you're only finding one opportunity that meets your criteria per week. And if you have a decent risk to reward ratio, you're only risking a small amount of your account per trade. You're only getting it right 66% of the time, which is actually pretty high, but but not by all means not unreasonable at all. 66% you know, there are a lot of systems that produce 66%. That's certainly achievable, very achievable. Then you end up with a healthy return, as you can see here. Just as a side point on percentages there, these can actually, accuracy percentages, these can actually be deceiving, because a 66% return, accuracy rate is getting it right twice as often as you get it wrong. Okay, you've got to think of it in those terms, because a lot of people think 60%, for example, is just a little bit above 50%. It's actually quite a lot above 50%. It's actually 50% above 50%, because 60 is 50% higher than 40. So anyway, getting sidetracked there. So one trade a week, 66% accuracy, and we get a healthy return by most people's standards, a solid return, very solid return, in fact, at low risk or conservative risk. Now, what if we did 2 trades a week? So 2 trades a week with 2 weeks off a year. So it's 100. Now, of course, things start to get a little bit more interesting there in terms of your total return. Now let's take a final example here of a high accuracy system with a low reward to risk. So this is basically the opposite end of the scale to the Jeff Bezos notion or quote that we mentioned before. Okay, so 100,000 in your account, same 1% risk. Let's say we've got a risk to reward ratio of 1.25, or let's just say 1.2, in fact. Let's just say, for example, just as a quick side example, we've got a 50% payout there. So even that, a 50% payout, 50% accuracy, quote unquote, getting it right versus getting it wrong, at 2 trades a week, produces you better returns than your average fund manager. Okay, but that's not what we're doing in this example. Accuracy rate there at 50%. Let's say we've got, let's say this is a high accuracy system. Okay, 75%. So we're actually getting it right. You're getting 3 times as many winners as you are losers. Okay, but your risk to reward ratio there is only 1.2 to 1. What you can see there is that it produces a very good return there at 65%. Let's say your risk to reward is even, so you might be, so on a as you can see here, you're risking 1,000 to make 1,000, but you have a higher accuracy system there at 75%. You get a 50% return, and again, this is based on just 2 trades per week with 2 weeks off per annum. Okay, so there's this interrelationship between the probabilities that needs to be understood. What it all comes down to is this idea of expectancy, right? Or in fact, your average return, the average return that you're receiving on an opportunity, taking an opportunity that is, that meets your criteria, your investment criteria, your trading criteria, your system criteria, your models criteria, all the same thing. Okay, so what is the average reward that you are receiving for taking an average amount of risk on your portfolio? That's what it comes down to. Then once you can determine that, you simply multiply it by the total number of opportunities that the system produces, and that gives you your end of period return. Okay, and as a concept, it's about as simple as that. So I suggest anyone that's looking to trade for themselves or invest for themselves, I strongly suggest you get in there and you understand very clearly everything that's in this calculator now. It's nothing to do with technical analysis or fundamental analysis or any of these other fancy type tools. They are tools, is what they are. Tools that are designed for specific purposes and specific jobs only. It's just laws of the universe type stuff once again, and it's something that you really, please understand, you really do need to understand this if you're going to give yourself any reasonable chance of success. So the majority of our clients are investors, not traders per se, and they're investing in our managed services. So for them, I'm just really trying to give them a little bit of peace of mind and transparency about the sort of principles that we run on. But if you're trading / investing for yourself, until you understand this, you shouldn't even bother with Fibonacci and ATR and MACD and trend lines and all the rest. They're all fine for specific purposes, but unless you are able to have this solid mathematical foundation in place, psychologically and practically, then you just really shouldn't be doing anything, quite honestly. This is an absolutely essential concept that needs to be understood. So it's an understanding of these concepts that is going to determine whether you are a trader or / investor again, or whether you're just a gambler. Okay, and there's a blurred line between the two. You've got to understand that. If you think back to the earlier piece where the two are sort of side by side, one guy is jumping up and down and cheering at the computer screens, the other guy is jumping up and down and cheering at his at the poker machine screens. You've really got to decide what you want to be. You can't, because you can't consider yourself a proper market professional in any sense of the word if you don't have, or if you can't be bothered to pull out a calculator every now and then and invest a little bit of time in understanding the concepts that are truly determining your success, not these other gimmicks and rubbish that we're constantly exposed to in the industry. So you've got to ask yourself, are your decisions founded upon pure expectation, or are they founded upon hope? So pure expectation in the sense of pure, logical and rational, objective expectation, as opposed to opening yourself up to the possibility of self-deception and bias, delusion, wishful thinking, and all the other types of things that we're just naturally prone to as human beings, and there's just no two ways about it. All right, so investing in a system with a positive edge is what it really all comes down to at the end of the day, the week, the year. Again, if you're a trader, you are just someone who's investing in yourself, or investing in a system that you have developed and or manage, instead of investing in someone else's system. That's the real distinction between a trader. It's not actually nothing to do with the concepts as such. It actually comes down to the implementation. Okay, so irrespective of whether you're a trader, investor, technical analysis, fundamental analysis, you have to have a positive edge. And if you don't even know what a positive edge is, then, well, you're putting yourself at a major disadvantage, and you're basically subjecting yourself to all the risks that come with emotions and everything else, as I say. I try not to repeat myself too much. So we take the risk first approach, obviously, and risk has to be considered in terms of likelihood and impact, as we saw on the calculator there. It's not just about the probability of loss, but how much that would affect you, likelihood and impact. So we've gone through this. We mentioned this piece a number of times in different presentations, but it's actually not just about risk. It's actually more about outcome or effect. Again, thinking back to cause and effect. So outcome, of course, can be positive or negative, and we have to look at the positive or negative outcomes in terms of probability and impact, or likelihood and impact. That's what gives us the magic numbers at the end of the day. and provides us with the closest thing possible to a holy grail in this system, finding a positive edge that you can that has downside protection and that you can actually manage reasonably in terms of risk and everything else, is the closest thing to a holy grail, despite what any of these internet gurus might want to, or other gurus might want to try to tell you. So trading and investing, the markets are simultaneously a game of attack and defense, offense and defense, and that's what that calculator that I've mentioned is there to try to help you determine, again in quantitative terms, defined terms. Okay, Invest Unity clients prioritize the prevention of large losses above all, flexible and adjustable risk levels, fast and easy access to their cash, and a balance between safety, performance, and consistency. The balance there is the key part in terms of this session there. As I hope I've been able to illustrate to some success, it's not necessarily having a high accuracy system, and it's not necessarily about having a system that produces you wins that are 100 times greater than the losses. It's about the way the averages will play out over time as part of a system. And so from a psychological perspective, it's incredibly important to understand this, because on an individual trade basis, or even on a week's worth of trades, things may appear random, or they may appear to be something that they're not. So we can't think in terms of weeks or days or individual trades. Certainly not. We have to think in terms of systems or models and the way that things are going to be playing out over time. Okay, I think that might be about it for now. So does the opportunity make mathematical sense, or does it not? It's really what it comes down to. Invest in the system with a positive edge. We're going to be doing more. We'll do some more advanced stuff at some point. We'll talk about some more sort of in-depth modeling type concepts there, but we'll leave that one for today. Yeah, so calculators and spreadsheets can get a little bit confusing. Let's try to give a very simple example, as simple example as I can. And we touched on this, we actually went through this in the last presentation, but I want to recap it. Investing in a system with a positive edge, in order to understand that, you need to know what your average profit is, your average loss is, and your profit to loss ratio, or your win ratio, win percentage. Now, in having that information and doing some basic calculations, basic maths, you get something called expected value average. So for those of you that are going to go and play around with the calculator, it's actually this one here, expectancy. That this one shows it as a raw number, and this one shows it as a dollar number based upon your account size. Okay. So expected value average, or EV, is how it's commonly called, EV. And when you have your EVA, when you have that number, then you can multiply that by the total number of opportunities that your system produces to get your total return. Total return over a week, a month, a year, a decade, a lifetime, it doesn't matter. Okay? So all we're trying to do when we look at these systems is we're trying to determine the average value of an opportunity produced by the systems. We don't think in terms of winners versus losers, not on an individual trade basis. We think of in terms of whether or not it's an opportunity that meets a criteria. That's all it comes down to. Does the opportunity meet the criteria according to the system? And then, of course, once again, the next question is how many opportunities does the system produce as such. So I try to think of as simple as possible type example, or more of a real life example, because financial markets aren't real life as such. They're representations of the real life, measurements of the real life, you might say. The neatest, best fit example I could come up with was this fruit and veg stall. And it's a side of the road, as you can see, fruit stall there. And it works on the honesty system. It's an honesty box. So I'm sure most of you know what that is, but there's no one attending it. You have to you pick up your fruit and veg and you put your money in your thing in the box before you drive off. For those of you that have, I don't know, some of you younger folk might have never seen one of these. I'm not sure. I'm from Adelaide, and we used to see these in the Adelaide Hills quite a bit. There we go. Digressing a bit. Now, there's no hugely complex mathematical formula required. That is actually an expected value formula, or one related to it. You don't need that. Really simple stuff if you actually boil it down and just invest a little bit of time to think about this and how it could apply itself to the markets. Now, in terms of an opportunity produced by the system, the model, the business, doesn't matter. In the case of this model, this business model, we're looking at a car as an opportunity. And a car that approaches is an opportunity that meets the criteria for the business model. All right, makes sense. Same thing works for bakeries and shoe stores and everything else. Nice and simple. All we need to look at is the total sale profit minus, in this case, the total loss due to theft. Okay, some people are going to steal from you because it's an honesty-based system, divided by the total number of opportunities for the day, the week, the month, the year, whatever period you're trying to analyze. Let's say, let's just say the day for the sake of this example. So the total number of opportunities, which in this case once again is the total number of cars that approached for the day. Okay, so we say we collected $100 in profit for the day, $10 was stolen from us, and the total number of cars was $10, or the total number of opportunities was $10. Well, very quick division there. $100 in profit minus $10 in loss means you've got $90 left over, divided by 10 opportunities means that the value of each opportunity is $9, or the value of each car approaching, irrespective of whether they buy something from you or steal from you. It's $9. Okay? And so your job then, assuming you were looking to maximize your fruit and veg stall, would be to maximize the number of cars that approach your stall every day, because you just know that each one is worth $9 on average. So it sounds incredibly simple, and it sounds like a very quaint and maybe even a little bit of a silly example. Well, it's just something that so few people understand, number one, and even fewer actually bother to apply when it comes to their approach to the markets. But you have to do it. You have to understand this. It's not just there to determine the profitability of your model, your system, your business, your approach, or whatever it is, but it's also there to very much help you from a psychological / emotional perspective, in that you shouldn't worry about your losers. You shouldn't worry about the outcome or the effect of any particular trade. If you've followed your criteria and you've limited your downside, then it doesn't matter. It's just a part of doing business. Okay? So you on an individual trade basis, you never actually really know whether this is something that's going to be part of the long-term statistical average, or if this is one that's just going to be, quote unquote, falling within the realm of luck. Okay, so we call things luck when we don't really understand the reasons for them. Okay, but nothing is actually really random. There's always a cause and an effect, and we only see those averages, those true laws of the universe again type stuff play out over time. So not having a proper approach to risk and a proper understanding of uncertainty and randomness and probability especially, or certainly, is what causes people to struggle with the psychological aspect of trading, the aspect of emotional interference and self-deception and self-delusion and all the rest. Well, this is the point you want to get to. You want to not worry about cars on an individual basis. You've set up an honesty type system, and you've accepted the fact that some people are going to steal from you. That's just the name of the game. But you know that there's more good people than bad people. There's more honest people than dishonest people. Averaged out over time, every car that approaches is worth $9 to you. Every opportunity that your system produces is worth, in this example, $500 to you. Okay? If you can get to this point, then you should have already overcome a lot of these psychological challenges that people struggle with for years and years and years. And if you can apply this over a reasonable period of time, you've reached the closest thing possible we have in this business of a holy grail. Okay? We know what the numbers are. It's now just a case of repeating it again according to the laws of the universe, and nothing fancy or based upon hope or luck or misunderstandings of the concept of randomness. Okay, so when you do that, you have just a second. Okay, so this is a distribution curve, a probability distribution curve, obviously similar to that one there. And this is a random distribution, as you can see there. This is not this is not the system that I mentioned, by the way. This is just an example, a random example. Talking about this thing about the Holy Grail, of course, you want to get to the point where you've got your downside protected against black swan type events. Black swans are once again unknown unknowns, unknown risks that can't be predicted no matter what, and that's the reality of the markets. So we want to have a very strong protection in place for them no matter what. We also want to have strong protection in place against mid to large size losses, and so that all of our trades or opportunities fall within this healthy green area there, which is small profits or small losses, break-evens or large losses. Once again, small to medium gains, break-even, large gains or small losses. But we never want to take large losses at all. We just want to remove the possibility of that as much as humanly possible, realistically possible, and we want to do even more to protect ourselves against the devastating losses, the catastrophic type losses, like you could experience in black swan type events. So that is the holy grail, so to speak. And it all comes down to, once again, investing in a system with a positive edge, whether it's your system, someone else's system, or whether you want to call yourself a trader or investor. It really doesn't matter. It all comes down to this idea of positive edge. So that's all for now. Thanks very much for coming and getting through the whole thing. Thanks for coming. Bye for now.